What's up, guys? It's Rob here, and we need to talk about Russia and the stock market, the crash that we're currently experiencing, and why statistical data actually shows we're likely to move up stock price wise in the next couple of weeks. So let's take a look at the chart right here and just admire how far the stock market's actually falling, right? We're down about 1% on the day. We have not seen a pretty past couple of days over the past while, right? We've been falling quite a bit, and it is on Russia-Ukraine tension, okay? Russia and Ukraine are not looking good at the moment, all right? U.S. stocks fell for the second week in a row on this whole conflict, and the Wall Street Journal just reported that U.S. officials expect Russia to attack in a few days. Now, this is exactly what they said last weekend, so I don't know how much credibility we can actually give this because they said the exact same thing last weekend, right? They said an attack will probably come in the next couple of days, and now they're saying the same thing. So I would take that with a grain of salt. However, Joe Biden is expected to move U.S. troops closer to Ukraine. All right, that's certainly going to raise tensions. However, all right, this is the good part. Markets tend to overreact to geopolitical events. Now, we're going to look at a study that explains exactly how they overreact and what we could see in the next month or next 3 months. But first, I want to show you, look at all of this. There is so much blood in the markets right now. There is so much fear. It's not just the stock market, all right? It's not just these mega cap stocks like Microsoft, Apple, Google, Amazon, and the smaller cap stocks. It's also cryptos, all right? Everything is moving down. Bitcoin down 4%, Ethereum down 6%. People are fleeing their assets and turning to cash. And that may not be the best solution, all right? There's a reason why. We're about to look at a study that shows where the stock market might be going. But first, I want to show you guys a new channel that I just started, Rob Almazy Rants. And basically, we just take clips from the morning live streams we do every morning. Feel free to subscribe to this. We'll post some interesting videos every day we do a live stream. And if you want to find it, you can just search Rob Almazy Rants in YouTube, or it's the featured channel at the bottom of the main channel page. So feel free to look at that if you guys want. Now, the study that we're looking at, right? What history says about geopolitical events and the market, all right? This is actually really good news for us, what we're about to see here, okay? A study was conducted that looked at 29 different geopolitical crises, starting with World War II, and found that on average, stocks were higher 3 months after a geopolitical shock, all right? That means at least 50% of stocks were higher 3 months after a geopolitical shock. 66% of the time, they were higher after only 1 month. So this situation is, I will admit, drawn out. It's been lasting for a bit. We're still technically going through the geopolitical shock that we're experiencing, right? And not all of this decline is purely the Russia-Ukraine situation, right? Some people are worried about the Fed raising interest rates, but for the most part, what we're experiencing right now is a lot of Russia-Ukraine tension. And it seems incredibly likely, in my opinion, that we could see a big jump in stock prices. And in fact, the study, or at least the people who conducted the study, actually said the odds that stocks will be higher increases as time passes after the event. In addition, stocks sometimes jump sharply after a crisis, so getting out of the market could have significant opportunity costs. And I completely agree with that, right? I'm a bull on stocks. I think that stocks will likely be doing well in the relatively near future. I think that we need to get through this crisis. I think that we need this crisis to come to an end. I think we need the tensions to cease and for troops to be removed both on the U.S. and the Russian side, and that will probably help out stocks quite a bit. I think that we could see a pretty sharp increase in stocks, especially smaller market cap stocks that seem to be suffering a little bit more than the overall market today, right? The S&P is down 1%, Sundial's down 6%, AMC is down 5%, DWAC down 2.5%. A lot of the smaller market cap stocks are suffering quite a bit. And another reason why I think it makes a lot of sense to, instead of be selling stocks, be buying them is because of this equation. Now, if you've followed the channel for a bit, you know what this equation is. It's essentially the equation that we can use to determine stock prices during most cases, right? Stock price equals essentially expected return on the stock. You expect to have a certain return on the stock. The higher that expected return, the higher the price, minus the risk, okay? So when stock's risk is higher, when stock risk goes up, you actually have a lower price. And that's why you subtract the risk from the expected return, all right? When stock expected return stays the same, risk goes up, the price goes down. And that's not actually what we want, right? We want for there to be, little to no risk. We want risk to go away, and we want expected returns to go up over time, and thus price should increase over time. However, what we're looking at right now is a situation where we have a significant buying opportunity, in my opinion, right? Because risk is actually very high. People are viewing the stock market as a very risky place to be. There's Russia-Ukraine tension. There's the Federal Reserve potentially raising interest rates. There's inflation. And a lot of people are viewing it as a very risky time to be in the markets. Now, that means that since risk is going up so much and people are viewing it as such a risky time to be in the markets, the prices of all of these stocks has gone down dramatically, and not just the overall market. I mean, you can look at the S&P and you can see that the S&P, sure, it's down a bit from the highs. If you look over the past year, it's down a bit. It's down maybe 10%. But there are other stocks. There are smaller market cap stocks, and ARKK, Kathy Wood's investment fund, actually tracks a lot of the more growth-oriented stocks. And you can see that over the past year, her fund is down about, 58%. So a pretty dramatic decrease in the price of ARKK, and a lot of the more growth-oriented stocks, right? Some of them smaller market cap, some of them have decent-sized market caps, but these are more growth-oriented stocks, and these have certainly been suffering, not just over the past year, but over the past couple of months, and even more recently, making new lows, actually, just today. So there is a significant buying opportunity. We might talk about Kathy Wood in some other videos and explain her thoughts on the market and where she thinks these stocks are going. So if you want to see that, make sure to subscribe to the channel. We'll probably do that at some point in the near future. And other than that, guys, have a great day. Keep in mind, none of this is financial advice. I'm not recommending anyone buy or sell any certain stocks. And I'll see you in the next one. Bye.